I've got on the phone with me Michael Braswell of Braswell Capital Solutions. Michael, welcome to the show.
Thank you for having me, Roger. I really appreciate this opportunity.
Yep, we've known each other for a while, and I've watched you do business, watched the way you conduct yourself, and I've known all along that I had to get you on the show and introduce you to the Flipping America audience. Folks, I introduced Michael in the opening segment, but let me just rehash. Michael founded Braswell Capital Solutions. It's his eponymous company. There's your big word for the day, named after himself. And with this company, he provides financial solutions to real estate investors. And you operate all across the country, right?
We are. We're a nationwide brokerage.
Okay. So now you're doing what is generally referred to as a hard money loan. And, I've talked to some people who prefer not to call their product hard money because that sounds kind of hard. So do you have something you prefer to call it?
Yeah, I don't particularly care for the hard money term. I define hard money as a loan that's hard to qualify for. And if you've ever tried to get a conventional loan, those are hard money loans. What I do is fairly simple. What I do are asset-based loans. Yes.
Well, and that's where it really got its name because it's based on the hard asset, not pulls on your credit or soft determination. It's based on the asset itself. So, okay, let's just pretend that you've got people out there because, hundreds of thousands of people are listening to this. Some maybe for the first time. We had new listeners all the time. And they're thinking, all right, what is an asset-based loan? And why don't I just go to the bank and get one? Why do I need Michael Braswell?
Okay. So first of all, a bank is not going to do an asset-based loan. Their loans are what we call borrower-based. 90% of the underwriting is based upon the borrower's financials, their credit, their income history, their pay stubs, their tax returns, trying to determine what their debt-to-income ratio is to qualify for the property. Whereas asset-based loans are quite the opposite. 90% of the underwriting is based upon the property itself, 10% on the borrower. And what that means is that they're looking at the condition of the property and they're looking at its after repair value, what the property will be worth once that investor does the renovations they say they're going to do. What realistically can they expect to sell that property for once the renovations are complete?
So you as the lender, how do you protect your interest when that property isn't complete? When they first buy it, it needs work. And we should also point out that this type of loan is usually being made on investment properties that need some work and there's some repairs required. And so banks won't even loan on those kind of properties a lot of times, no matter what your credit is, right?
That's right. Banks want houses that are in move-in condition. They don't want to lend on anything that's a junker, that's dilapidated, that's maybe been abandoned for a couple of years and it needs renovations from the roof to the floor. Banks want something you can live in right now. So frankly, you can't even go to a bank and say, I would like to get a rehab loan. Only type of rehab loan you're going to get from a bank is if you're using FHA's 203K rehab program, in which that's only used for owner-occupied residences. You can't use that program for investment properties.
Right. So you specialize in working with investors and you provide money for the purchase and also for the rehab. But where I was going with my previous question was, I think that you protect yourself by, they don't get all of the money right from the beginning. They're going to be pulling out construction draws, right?
That is correct. So typically what happens is the lender is going to fund up to 90% at the most of the purchase price, and you'll get 100% typically for the rehab budget. Now, what that means is the lender is going to release in draws. Let's say, your scope of work calls for you getting 4 draws on that project. As an investor, what you're going to have to do is start the project with your own money. In order for a lender to protect themselves, they're not going to give you the money upfront for work that is not complete. It's on a reimbursement schedule, which means once you've done the work, a home inspector is going to come out, verify the work is done to code and that you actually did the work you said you were going to do. They're going to approve that draw request, and then within 48 hours, the lender is going to reimburse you the money that you need in order to pay your contractors, and then you're going to move to the next phase of the project.
So do you work with your investors and teach them about doing interim lien waivers?
No, I do not.
Okay, that's all right.
Yeah.
I'll teach them that part.
Yes, you teach them that part. You've done all the rehabs. I try to keep my thing as simple as possible. I just talk about the financing piece, and I make sure that I do a good job with that.
All right. So You said it's easy. So how easy is it? I mean, do you have to have good credit? What do you have to have in order to get a loan from Braswell Capital Solutions?
Well, on the hard money side, you just needed a minimum 600 credit score, typically. I have a lending partner I just met with actually yesterday that they don't require you to have a certain credit score. They're really looking at the merits of the deal. If it's a good deal and they're comfortable with you as a borrower, you have the down payment and the closing cost to bring to the table, you have your scope of work put together, you have all your paperwork in order, they'll fund you without even pulling your credit. But I say, generally speaking, your minimum credit score is 600, and you're going to have to put down at least 10% of the deal.
10% of the purchase price.
10% of the purchase price. That's typically for more experienced investors.
Okay.
10% of the purchase price for a new investor, a new flipper, you're going to have to put down a minimum 10% of the total project cost, which is the purchase price plus the rehab budget.
Okay. All right. So we're going to be able to borrow up to 90% of the total project cost, but you've got another ratio in there because the total project cost can't be over a certain percentage of the after repair value. Am I right?
That's correct. So the maximum after repair value is going to be 70%. So we'll lend up to 70% of the property's after repair value.
Okay. Up to 70%, but you only get 90% of what that cost is. So if you're, let's say you're doing a rehab project and your total all-in cost is $150,000. You're saying that you can only borrow 150 less 10%, so that would be 135,000, right?
No, what we're saying is you can borrow up to 70% of $150,000.
Well,
So
no, let's say the ARV on that one is like 300,000. So
okay,
that ratio is fine, but your total job cost is 150,000.
Total job cost 150,000. You're going to have to put down typically 10% or 15% of that
Okay.
for the down payment to get into the project.
What about origination fees? Is that on top of that 10% number? Or
It
15?
is. So it's your 10% down payment plus origination fees. They're going to range anywhere from 2.5 on the low end. They can go up to about 4%, 4 points rather on the high end. I really try to keep the pricing very competitive. Most hard money lenders are going to charge 4 to 5%. So as a broker, I'm very focused on finding the lenders that have, very low origination fees. So by the time I build in my profit margin, you're going to be paying 2.5 to 3.5 points typically total with my brokerage fee included.
Okay. And what kind of interest rate do these loans have?
Anywhere from 9 on the low end up to 13%.
Okay.
Yeah. When you're doing business with me, you're not going to get any higher than a 13% interest rate.
All
9
right.
to 13, 12-month interest only.
We have to jump into a break right now, but when we get back, I know that some of the people out there right now that are hearing about this for the first or second time are thinking, man, 13%, I can get 3% money at my bank. We'll be right back.
Peter Faulkner here. I attended a one-day flip starter training session led by Roger Blankenship, and I was amazed to see what has happened in Roger's life in the last 15 or plus years, flipping over 800 houses. And in this one-day training, he told how he did it and what the pitfalls, the blessings, the benefits, and how to do it. And I was so impressed with how well organized and how smooth the training went today. If you're tempted or encouraged to go, go. It was not a bad price, and if you get a chance to do it, even just to consider investing. But I just want to thank Roger for a great day today and appreciate what he's doing. Thank you, Roger.
And we are back. I'm Roger, he's Mike, and we're talking about getting money for your deals, and Mike makes it easy. The thing where it gets a little hard is when these people are thinking about, oh man, 9%? Really? I got to pay 9%? Okay, let me hear what you have to say about that.
Okay, so you have to look at the risk that lenders are taking, right? These are risk-based loans, which means lenders are pricing this based upon the fact that you're purchasing a property that requires work, and they're lending you money based upon what an appraiser believes that property is going to be worth once you finish the renovations. These are lower documentation loans. So you're not having to provide, in most cases, tax returns, no W-2s, no pay stubs. There's no debt to income ratio requirement. So for the risk that these lenders are taking, I think 9% and keep in mind, these are interest-only loans, I think is well worth the risk. I mean, you can't go anywhere else and get this money. So, when you go to a bank and they're going to give you 4.5%, it's because they know you're going to live in that house and the house has already been, in move-in condition. Whereas, these loans are speculative on the hard money side, right? It's based upon assumptions, and hopefully you'll be able to sell this house at this value at some point in the future. For that, banks want to be compensated for their risk. And so they're going to charge you points, and they're going to charge you a higher interest rate in order to justify them taking that risk.
You made a very important point there when you mentioned the banks. Basically, my feeling about the banks is they'll loan you an umbrella on a sunny day. But the banks do make a lot of money on real estate, but they are very careful and very conservative. And so when they're loaning money on real estate, they're taking as much of the risk. In fact, they're taking almost all of the risk out of this thing through their underwriting guidelines. And one of those, they know if you're moving in, then the house has to be in decent condition. And there is a whole new element of risk involved when, and you hit it right, you hit it nail right on the head. When there's someone that's going to repair the property, then all of the risk for the lender goes on that person's ability to perform. Yeah. And so that makes it a riskier loan. And so here's the other thing that I would add from the investor's point of view, and in defense of your loans. If we know what the cost is, it's not that difficult for us to count that cost when we're analyzing a deal to know whether it's a good deal or what we might want to offer. All we have to do is just know what it costs. It doesn't matter to me if you want to charge 25% for the money. If I need the money and I know that I can buy the deal at a low enough price and I can still come out of it okay with decent returns for my effort and on my cash, it doesn't matter what the interest rate is. And that's the thing that most people miss. They focus so much on the interest rate, they don't really think about the opportunity.
Right. And for example, speaking of the interest rate, say, for example, you have a 12-month interest-only rate, right? That's 1% a month. So if you're borrowing $100,000, you're paying roughly $1,000 a month, a little bit less actually. You're paying about $850 a month, in interest. Now, if you're planning on rehabbing that property and getting out of it in, say, 3 or 4 months, you're only paying, that interest. So for example, if you have a 12-month loan and you get out of that property in 6 months, really you're only paying 6% on that money. You're only truly paying the full cost of that interest rate if you hold on to that property for 12 months. So I tell people speed is of necessity. The moment you get that money, you need to quickly get it renovated and get it sold so that you can increase your profit margin, right? Pay the lender, what you owe them, and then move on to the next project. As long as you're generating at least 15% cash on cash return, I think you're doing pretty good, if you want to get into flipping.
Yeah. And 15% cash on cash return is pretty thin for a fix and flip in my world. I probably wouldn't do that deal. So I'm thinking about your $100,000 analogy. On that property, I would want to have a gross profit of around $30,000. And so by the time we pay, $6,000 or maybe $9,000 between origination fees and interest rates over 6 month time, that's going to leave us a net of $23,000, $24,000. So would you pay $9,000 to make $23,000 or $24,000? I would do that every day.
All day. In 6 months time, if you compound that, right? If you annualize that, you're making a killing. There's nowhere else you can make that kind of money legally. I tell people flipping is a beautiful thing if you do it right. And that means having a great contractors, great tradesmen. That means finding properties at a bargain below market value. All these things come to play to really determine what your rate of return is going to be on that. And don't forget, people have to pay, if they're going to hire a real estate agent, they're going to have to pay typically 6% commission as well.
Yes. And those are things that go into the calculations as well. And we've got that built into our spreadsheet, of course.
Okay.
All right. So let's go to a break. And when we get back, let's introduce our audience to Michael, the man. All right. Because I want them to know you on a personal level. Hey, you're listening to Flipping America, where we teach people how to make money about real estate. And today we're talking with Michael Braswell with Braswell Capital Solutions. And you can find them on the web at braswellcapitalsolutions.com and learn all about the products and the offerings that they have. And Michael's even setting up a way that you're able to apply for your loan right there on his website. He makes it as simple for you as anything I've seen. So we're going to go now to a commercial. And when we get back, we'll get to know him a little bit better. We'll be right back.
Learned a whole lot of different things that I didn't know. Learned how to flip houses, learned how to make money in real estate. I learned how to hire contractors. Not only did we get a big overview, but we got into the nitty-gritty details of really understanding how to make money in real estate. It was an education that I wish I would have given to Roger before I gave to the University of Georgia. Pretty powerful. It's actionable information. I can go out tomorrow and start making money with what I learned here today.
And we are back. One of my favorite questions, Mike, to ask people in this business is, I've been around in this real estate business now for 16 years, and I've met a lot of people, and over those years, I've always been curious what people started out to be, because almost nobody, there are a few people that are realtors and a few people on the financial side, but almost no one I've met when they were young intended to be real estate investors or doing exactly what they're doing now. So my question is, what did you want to be when you were a little kid?
What did I want to be? I wanted to be an engineer when I was a little kid. I thought I was going to be some type of electrical, mechanical engineer, something like that. But when I got to college, I quickly realized that I don't really like engineering as much as I thought I did.
Yeah. I have a daughter who went to Georgia Tech to be an engineer, and after 2 years of it, she said, "Dad, the courses are fine, but I don't think that this is for me. And for one thing, I think I have more personality than an engineer does, and I always knew that, and you do too, my friend." Anyway, so I have to be careful about that, because there are engineers that are listening to this, including some of my very good friends that are former engineers. But so engineering wasn't the thing for you. All right.
No.
So then what happened?
So, I mean, I was always good with numbers. So what I did was I switched my major over from engineering to finance. And I figured, I can get a degree in finance and I can work anywhere with that. I can work on Wall Street. I can work on Main Street. People always need folks in their finance department, crunching the numbers and doing that type of thing. So I figured that a finance degree would give me the most opportunity once I got out of college. And it certainly did. My first job was in insurance. I used to work for a very large risk management firm when I got out. I did that for a couple of years, and it was okay. I mean, it was cool, but I realized, working in the cubicle just wasn't for me. So I, did that for a number of years. And then in 2005, I got my real estate license. This is when the market was booming and going really well.
Yeah, 2005.
Yes, I got my license. I was a full-time agent for 3.5 years until the crash, right? We all remember that. I didn't really feel the pinch until the first quarter of 2009 is when I got out of the business. Congress had done away with a bunch of different down payment assistance programs, Nehemiah and all these other ones that were going on. And my focus was mainly on the first-time home buyers, right? And so when Congress killed the down payment assistance program, because that was one of the things they blamed for the crash, the fact that people didn't have their own skin in the game. They were getting this down payment assistance. And so they tried to attribute some of the crash to that, which I think you and I both know it had nothing to do with first-time home buyers crashing this market. But needless to say, I got out of the business in 2009, and then in 2012, I found my way back into the mortgage business. I went and worked for a large bank. I was a mortgage banker over there. Had a lot of success, but I quickly realized that when it comes to working with real estate investors, for every 10 investors I talked to, I maybe could get one approved for a loan. And I'm like, man, this is not going to work. 1 out of 10 closing ratio is not good. And I realized that, banks want to lend to owner occupants. They don't really want to lend to real estate investors. they have to offer investing real estate loans to investors because they are federally chartered, organization, and they have certain stipulations they have to meet in terms of the rules and guidelines. But really, they make it difficult for people to qualify for an investment loan. So I got out of that into the hard money, private money sector, and I've been in that ever since.
Okay. And I guess you like it and it's going well for you, right?
Yeah, it's going well. I worked for, a company prior to starting my own firm last year. I really learned a lot. I met a lot of great people. And so it's like, let me take my knowledge and my contacts and launch my own company. And I'm proud to say that we've done very well since I started. We started June 2017. And, we got a small staff of some dedicated folks over here. So we're just churning away and just making sure we put a good product out there and we deliver on our promise to, help investors, whatever your investment goals are.
Okay, so talk to us a little bit about the process a little bit more. I had said right before we went to the last break that people could go to your website and sign up. Is it really that easy?
Yeah, we have a place where you click on the application link and you can fill out the basic information about what it is that you're trying to do. That comes over to me. I'll take a look at it. And then if it's a viable deal, right, if you have a deal and the numbers work, I'm going to give you a call. We're going to talk about the deal. I'm going to ask you first, comps, what comps did you use in order to determine your after repair value? Because that drives everything. It's the ARV, right? If you bought the property right, you have a realistic rehab budget. The main piece of that puzzle is the ARV. So once we can kind of nail down how they came up with that ARV, then we're going to put the financing together to get them that property.
Now, what if you get this application from Milwaukee, Wisconsin, or Pittsburgh, Pennsylvania, a couple of places where we're on the air?
Yeah, if we get it from there, I'm going to tell people, have you done your due diligence? That's the big thing. It's easy to get a property under contract. But where I see a lot of investors fall is that they haven't done their due diligence to really to find 3 solid comps to support the after repair value of their property. And I give investors the Mayo equation. I'm sure you know it, but I'll go ahead and give it to the listeners again because it amazes me how many people aren't familiar with this equation. And the Mayo equation is simply the after repair value times 70% minus the rehab budget is what you should pay for that property.
The most you should pay.
The most you should pay. And I tell people, do not violate that equation under any circumstances, because number one, you're not going to be able to get financing. And number two, it's not a good deal. You need to either renegotiate the sales price or work on getting your rehab budget down. But whatever you do, don't pay more than what that Mayo equation says you should pay for that flip.
Okay. So are there any states where you don't make these loans?
Nevada.
Sorry, Las Vegas.
Idaho. Yeah, there are a handful of states we don't make those loans. But pretty much where 99% of people are going to want to invest, we can do those loans. It's just in about 10 states around the country where we can't, because the state says you have to have a physical location in that state in order to, originate mortgages. And so, if you don't have a physical location in that state, then you can't do business in that state.
Okay. Well, we have a lot of listeners in Las Vegas. We're on the air there. And I have a friend that has an incubator operation in Las Vegas, and you could have an office there. Just a thought.
Okay.
Going out there. Hey, folks, we got to go to a break. He's Mike. I'm Roger. And we're talking about getting money for your deals. Mike can make it happen. And we'll be right back.
Hi, I'm Stu Schuyler from Tampa, Florida, and I'm here and just attended Flipping America by Roger Blankenship. And this guy is awesome. I am excited. I am going to find a house in the next week or two, and I may even hire Roger to be my mentor. And I'm going to go make some money, and I'm going to have some residual income, and I'm going to stop working for a living, and I'm going to make my money work for me with the help of Roger. I urge everyone to attend this meeting. It's awesome. All I can say is Roger's a great guy. I wish he'd have been my dad, but I'm 20 years older than him, so that wasn't possible. Anyhow, I made a great friend here today, and we're going to keep on trucking, baby. God bless America, and God bless this company.
And we're back. This is the show that teaches you how to make money in real estate, and we're trying to help you make the best possible decisions about what you get into and what you're doing. And to that end, we bring in a lot of information and resources. Now, we don't encourage everybody to go quit your job and start flipping houses like you see on TV. That seems fun, but they take all the work out of the what's visible on TV cameras, and it is tedious, and sometimes it's a job, and sometimes it's pain, and it's not for everyone. However, it is for some, and it could be for you. And if it is, whether you do it full-time or whether you do it part-time, you got to find money for your deals. And that's why I've cultivated this relationship with Mike Braswell and Braswell Capital Solutions. There are plenty of places you can go and find money. No question about that. But if you're like me, you want to work with good people, quality people. And that's why I'm proud that Mike is a sponsor of the show, and that we're able to recommend and refer him to you, my listeners and my friends out there in the listening audience. So, Mike, you've got some other products that you offer as well, and I don't want to get out of here without talking about them. Some other things that you can do for business people. Tell us a little bit about those.
Yeah, so, outside of the flip loans that we do, we also offer loans for buy and holds. So if you're a landlord, you like passive income, we have several different programs for that, for short-term rentals and for long-term rentals. We also do commercial real estate. These are more investor-friendly, lower documentation commercial loans for 5+ unit properties. You want to do multifamily, you want to do office, retail, industrial, mixed use, self-storage. We can get you financing for that. But I'm really proud about a product we started offering a few weeks ago. It's for unsecured lending. And what that means is these aren't asset-based loans, right? These loans are unsecured. There's no collateral needed. They're based upon you having a 660 credit score and verifiable income. And we can get you between $50,000 to $200,000 in funding in 5 to 7 business days.
Wow. What kind of interest rate?
Interest rates start at 7% and go up from there. Terms are 3 to 5 years, no prepayment penalty. So these loans are the fastest, easiest way to get the money that you need for whatever purpose. There are no strings attached with this funding. In real estate, we call this gap funding, right? So if you have good credit, you got a good deal, but you don't have any money, as long as you have a 660 credit score, we can get you the funding that you need for the down payment and closing costs so that you can actually get into that deal and make some money. This is a great program for wholesalers because wholesalers, right, they come across great deals all the time, but because they don't have the capital, they're having to wholesale that deal to another investor who's going to make a ton of more money than they're going to make. Now we have a product where 660 credit score, verifiable income, we can get you funding fast, simple, and dependable. No strings attached. Nobody's going to come and take any of this money from you on the back end. These are not credit cards. These are installment loans. So once the installment loan is set up, you're going to have that loan for the next 3 to 5 years. Sometimes, people use credit cards to get funding. But the bad thing about that is the creditors can go back in and they can cancel those credit cards at a later date when they review your credit report, which all of them are going to do. But with the type of funding that we do, these installment loans won't be closed out. So you don't have to worry about that.
Let's camp on that for just a minute, because this is a little bit of a scam alert. And there are a lot of so-called gurus out there that are doing this. They will show you how you can open up a lot of zero interest credit cards, and you can get $50,000, $100,000, $150,000 worth of credit with all these new credit cards. And then they tell you, go ahead and do cash out or cash advances on those cards. And what they may or may not tell you is exactly what Michael just said. In a month or two, those credit card companies are going to take a look at your credit again, and they're going to see that you have all of these open lines of credit, and they're going to get nervous because you don't make enough money to support all of that, and they're going to shut it down. That's why the gurus tell you, go ahead and pull the cash out, so that way you have it when they shut the account down. You know what that does to your credit score? It puts it in the toilet. You'll be in the 500s, and then good luck. And you may be thinking, well, I've got $200,000 now. I don't need good credit. Well, let me tell you something. Your credit score affects so many things about your life. Did you know, listeners, that your credit score affects what your insurance companies charge you? Also for your car insurance. Yeah, it affects a lot of different things. So be careful about those kinds of things. And Michael, I appreciate the fact that you're not doing that. But you are working with integrity and truly helping people. And I don't want to minimize what you said about the any to do loans on large assets, different types of commercial. You named a whole bunch of assets. There are any types of commercial assets you can't get lending for?
No, I mean, as a broker, right, we have nationwide relationships with lenders that do mobile home park financing to, land financing, all the whole gamut. If it's, real estate related, we can get you the financing that you need. But the main thing is, making sure that you have your documentation together, that you have decent credit, and that you have, money for down payment and closing costs. That's the biggest thing. It's not a lack of funding. It's people understanding, what they need to do to position themselves to qualify for these types of loans.
All right. Well, this has been an excellent summary. And Michael, thank you for taking time out of your busy schedule today. I know that you've probably got some loans to underwrite right now, and you've taken time to talk to us, and I appreciate that very much. Hey, we hope to have you back on the show again really soon, okay?
All right. Thank you, Roger.
All right. Take care.
All right. Bye.